Okay, so the next topic is IAS 40 investment property. Investment property. Not long ago, we learned IAS 16, IAS 16. We said IAS 16 prescribed the treatment for non-current asset. Non-current asset, property, plant, and equipment. So the IAS 16 basically applies to tangible non-current assets. Tangible non-current assets that is held by the owner for production or provision of what goods and services, and then for administrative purposes. So if you are having a non-current asset, tangible non-current asset for the purpose of producing goods and services, and then for administrative purpose, then you account for it using IAS 16 PPE. But if you have a non-current asset, land or a building, for investment purpose, then IAS 40 investment property is the standard to use. Okay, so that is it. So we'll know our objective for the standard, the history, the historical development, then various definitions that you have to know, examples of investment property, recognition for investment property. When should you recognize investment property in the financial statement? How should you measure investment property in the financial statement? What happens if you transfer investment property? How should you account for it? And when there is disposal of investment property, how should you treat it? And what is the disclosure requirement for investment property? So this is our objective for the lecture. So IAS 40 prescribed the accounting treatment for investment property and its related disclosures. So that's the purpose of IAS 40. Prescribe the accounting treatment for investment property. So what is investment property? We'll look at it very soon, but let's look at some historical developments. Yes, the IAS, we adapted it in 2001. Okay, but this standard had replaced some parts of IAS 25 accounting for investment, which had been issued way back in 1986, but the exposure draft was in 1984. The standard IAS 25 was issued in 1986. This investment property IAS 40 came to replace it. It's gone through several amendments, but the latest one was in December 2016. Okay, so with the historical development, I picked this from IAS Plus. I picked it from IAS Plus. I picked it from IAS Plus. So when you go to IAS Plus.com, it will take you through the various historical development, right? So that's IAS Plus.com. And then when you come here to the second one, that's the continuation. So when you go to IAS Plus.com, you find all the historical development from way back in 1984 to when IASB adopted it, various amendments through to the last amendment, which was done in December 2016. What is investment property? According to section 5 of the standard, investment property is a land or a building or a part of a building or both. So what you should pick from here is that investment property is a land or what? A building, a land or building or part or both. Land or building or part of a building or both land and building. That is held by the owner of that land or building or by a lessee under a finance lease to earn rentals or for capital appreciation. So that's the definition for investment property. So you realize that investment property is about land and building or both land and building. So if owner of a land and building is having that land or building or boat for rental purpose or for capital appreciation, then we say that is investment property. If you have a land, if you have a building or boat, the purpose for that property is for what? To earn rentals or for capital appreciation, you call it investment property. You purchase a land way back, let's say 2000, you still have the land there. It is definitely for capital appreciation. You want to wait so that if it gets a higher price and you sell it and you get some capital appreciation, right? Uh-huh. Or maybe you have a building for rental purposes. So you call those things investment property. Investment property. Good. Hostel is what? Investment property. Or the owners of hostel, they built it for rental purposes. It's basically investment property. So that is investment property. If you have a building, maybe apartments for hire for rental purpose, it's also as investment property. So on the face of your financial statement, you have to separate investment property from what PPE and also from what intangible assets. We also have a standard for intangible assets. IAS 38 is a standard for intangible assets. Is that okay? So on the face of your financial statement, you have to classify all these. So you have under non-current assets, you have PP, you have investment property, you have intangible assets. Remember, they all have what different standards for them. Is that okay? So the reason why we are teaching you all these things is that you should be able to classify them on the face of what the balance sheet. So when you receive your when you are working on you have a final account to solve and you realize that you have a property for rental purpose or for capital appreciation, then when you see something like that and you are preparing it, you have to classify it as what? Investment property. And very soon you get to know how to go about it, how to account for it. All right, let's go to other things. I hope you won't forget this definition. Will you forget it? Please, will you forget it? Will you forget this definition? Will you be able to distinguish between investment property and PPE? Hmm? Will you forget it? Okay, you should be able to distinguish it between what PPE and then what investment property. You let's move on. You get to learn a lot. So we have the standard has given you some examples of investment property in section 8 of the standard. Examples of investment property. Examples of investment property. Land held for long-term capital appreciation. You have bought a land and the main purpose of the land is to what? For it to appreciate in value for a long term. So maybe you bought the land for 10 years, 20 years, you want it to appreciate in value so that you will sell it. It's investment property. Land held for currently undetermined future. You have a land, but currently you don't know what to do with this land. Classify it as what? Investment property. You have a land currently, you don't have any idea of what you want to use this land for in future. It's what? An investment property. So classify it as such. Building lease out under an operating lease is what? An investment property. Okay, investment property. Vacant building held. to be leased out under operating lease, investment property. Property that is being constructed or developed for future use as an investment property. So property under construction for use as investment property, you classify it as investment property on the face of the financial statement. So if you have any of these when you're preparing your financial statement, you have to classify them as investment property in line with IAS 40. So the standard has been gracious to us to give us examples of investment property. So we know what investment property is. So what is investment property? What is it that is not investment property? The investment property is not. I'm giving you a number of them. What investment property is not. What investment property is not. You know what it is. So what is it not? What is it not? That's what we're gonna learn. You know that investment property is what land or building or both that is held for rental purpose or for capital appreciation or both. That is investment property. But investment property is not what an asset or a non-current asset for use in the production or supply of goods and services, because IAS 16 has taken care of that. IAS 16 has taken care of that. And no, IAS investment property is not a non-current asset for administrative purpose. IAS 16 is not an asset in the ordinary course of business held for sale, because IAS 2 has taken care of that, or in the process of construction or development for such sale. IAS 2 has taken care of that. It's not an asset being constructed or developed on behalf of a third party. So if you are constructing or developing an asset on behalf of a third party, it's a construction contract in line with IAS 11, which has now been replaced by IFRS 15, revenue from contract with customers. So these are not investment property. Now, again, investment property is not an owner occupied. Investment property is not an owner occupied. Okay. So by owner occupied, we mean including property held for future use as owner occupied, property held for future development, property occupied by employees, or owner occupied property awaiting disposal. Note that investment property is not an owner occupied. The next slide, I'll tell you what an owner occupied is. The standard has defined an owner occupied, so I'll take you through very soon. All you should pick from this slide is that investment property is not an owner occupied. And here I've given you the various uses of the owner occupied. They are all not investment property. Finally, investment property is not leased to another entity under finance lease. So non-current asset leased to another entity under finance lease is not investment property. If you want to know, I've been mentioning lease, operating lease, finance lease. You can read more on that. And IFRS 16, it will give you more insights on lease. Lease is a topic that you'll be learning in final year. Okay. Lease is basically about one party giving their asset to another party for periodic payments. That's what we call lease. We have two types of lease. We have finance lease and operating lease. Finance lease is long-term and operating lease is short-term. So if you lease your assets to a company for some few months, less than a year, it's operating lease. But if you lease the asset to somebody for years, let's say 50 years, 10 years, 20 years, when you see financial statement, you see leasehold property. I don't know if you've been seeing that. Leasehold property. This time you see leasehold property, it means that that asset is under finance lease. Somebody has leased the asset to the reporting entity. Is that okay? And they've been paying some periodic amount to the company who leased it to them. So in lease agreements, you have the lessor and the lessee. The lessor is the owner of the property who is leasing it to the lessee, right? So the lessee is like the tenant. So the lessee will be reporting in their financial statement as what leasehold property. So anytime the lessee is preparing their financial statement, they will recognize it as what one of their non-current assets because they've been using the asset for so many years. Remember, substance over form. So on paper, the owner is the lessor is the owner, but in real life, in practice, I mean, the lessee is using the asset for so many years, so they recognize it as an asset on the face of their financial statement. So what am I saying? An non-current asset that has been leased to another entity is not an investment property unless the person the asset was leased to the lessee would like to use it for investment property. But to the lessor, it's not an investment property. Is that okay? So this is what an investment property is not. So when you get a slide, try and then note all of these, right? In exam, you should be able to classify these non-current assets as PPE, as non-current investment property, non-current asset held for sale, as intangible assets, and all that. But so far, you've learned PPE and you are now learning investment property. I will not bring anything I've not taught you. That one I can show you. Any standard I've not taught you, I won't bring. Unless the standards you learned in last semester in intermediate one. For those ones, I will examine you on it. But anything you've not learned, I can assure you, I won't examine you on it. Is that okay? So if I don't teach you anything with regards to non-current assets, I will only examine you on PP and this. But I hope to teach you more though. All right. So this is what investment property is not. This is what investment property. You beg, I shouldn't teach you more. Is that what you mean? I shouldn't teach you more on these things. If that is what you want. Noted. This is what investment property is not. What investment property is not. Let me respond to these your comments. Madam, don't bring last semesters. But when we were treating IAS 10, what do you call it? What we just learned, events at a reporting period. IAS 2 resurfaced there. Have you forgotten? And even things you learned in second year resurfaced there. So IAS 2 will show itself again in a final account question, I can assure you. So stop begging, madam. Good. Let's move on to so what I've said so far has been summarized in the slide for you, friends. So the objective of IAS 40 is to prescribe accounting treatments and disclosures for it, right? Now, we know that investment property is a land or a building or both. It's held to earn rental or for rental purpose and for capital appreciation or both. That's what we've learned so far. So if you have a property for these three, then it's what you use IAS what 40. Use IAS 40. But then if you have a property for the production or supply of goods and services for administrative purpose for these two, what standard are you using? IAS what? 16. What is happening? You use IAS 16. Hey, what is happening to my screen? What's the last one? Sale in ordinary course of business. What standard will be applicable for that one? What standard will be applicable for this last one? IAS what? IAS what? Friends, talk to me. So this is IAS 16. The last one will be IAS what? IAS 2. That is correct. You realize that we are referring to the standard you learned last semester. And you are telling me not to examine you on it. So this one will be IAS 2. Oh, what is happening to my screen? Is it too small? Need a bigger one. Hmm. Wanted to write the IAS 2 for you. So this one use IAS 2, right? Mm. So I'll move on. So now you know the difference between IAS 2, IAS 16, IAS 40, right? I made mention of owner occupied. What is owner occupied? According to IAS 40, owner occupied is a property that is held by the owner or by the lessee under finance lease for use in the production or supply of goods and services or for administrative purpose. So anytime you hear owner occupied, this is what we mean. And from this definition of owner occupied, it is clear that owner occupied is what accounted for by what IAS 16 PPE. PPE are owner occupied. PP is owner occupied. Any land or building or any property held by the owner, okay, or lessee under finance lease for use in the production or supply of goods and services or for administrative purpose, we call it owner occupied. From this definition, it is clear that it's what PPE. It is accounted for using IAS 16. A common mistake is to treat owner-occupied building as what investment property because of its capital appreciation. That's why I've been stressing on the difference between investment property and then other non-current assets in this lecture. So that's what you should pick out from this lecture. What is the recognition criteria for investment property? Under what circumstance can we recognize an item as investment property on the face of the financial statement? When it is probable that future economic value will flow into the entity, just like PPE, when it's probable that economic value will what flow into the entity. By that we mean the company has control over the assets, it earns all rewards from the asset and it bears all risk. That's when it's probable that future economic benefits will flow to the entity. Two, when the cost of the item can be measured with reliability. So when these two conditions exist, then we can recognize an item as what investment property. It's the same as for PPE. I don't know if you remember recognition for PPE. Probable that future economic value will flow to the entity and then the cost can be measured reliably. The same thing for what PPE, so it hasn't changed. Measurement. What about measurements of investment property? How do we measure investment property? This one too, we have initial measurement and subsequent what measurement. Initially, investment property should be measured at cost, just as PPE. Initially, investment property should be measured at cost. And here it should include transaction costs. However, it should not include the following, because that shouldn't be included in what valuing investment property: startup costs, abnormal ways, initial operating losses incurred before the investment property achieve its planned level of occupancy. These should not be capitalized. These should not be included in what valuing what the cost of the investment property. However, cost should be what the purchase price plus directly attributable cost. Just like we learned in PPE, the cost of what an item of investment property should be the purchase cost or the purchase price, knowing what purchase cost entails from PPE is the same thing, plus directly attributable cost. We learned in detail what directly attributable cost is, right? So bring that knowledge here. But what you should know is that initially investment property should be measured at cost. And that cost includes transaction cost, but it excludes these costs. What about subsequent measurement? Subsequently, it can be measured using two models, using the fair value model and then the cost model. Can be measured using the fair value model or the cost model. However, the standard prefers the fair value model. The fair value model is preferred. You are having this asset for investment purposes, right? For rental purpose and for capital appreciation. So why would you like to carry it at cost? Why no fair value? Because you want the asset to appreciate so that you can sell it in future. So why would you want to value it at cost? So the standard recommend fair value. All right. So now we move on. So by cost, definition or explanation of cost, the amount of cash or cash equivalent paid or the fair value of other considerations given to acquire the assets at the time of its acquisition. That is the cost of the asset. The amount of cash or cash equivalent paid or the fair value of consideration given to acquire the asset at the time of its acquisition or construction is the same from what PPE, purchase price plus what directly attributable cost. What about fair value? What does it mean? The same from PPE, the price at which an item, the price that would be received or sell would be received to sell an asset or pay to transfer a liability, okay, in an orderly transaction between market participants as at what the measurement date. So that is also fair value. The same definition from PPE. So just want you to know what cost is and then fair value is. So this is what I've said so far. Initial measurement should be at cost, and cost basically the cash or cash equivalent paid, the fair value of consideration given, okay, to acquire assets. So that is the cost of the assets, and then the formula is the purchase price or the purchase cost plus the directly attributable cost. The cost of the asset does not include startup costs, operating losses, abnormal waste. So this is what I've said so far about the cost model. Sorry, about the initial measurement, which is the cost. Initial measurement, which is the cost. Subsequently, I've said that you can measure the investment property at either the fair value or what? At cost. So using the fair value model or the cost model. If you are using the cost model, then you have to carry the item at what? Cost less accumulated depreciation and accumulated impairment loss, just like PPE. It's just like PPE. Just like what we learned in PPE. Just like what IAS 16. Just like what we learned in IAS 16. But then if you are using the fair value model, then it means that at each financial statement date, you have to revalue the asset, determine the fair value of the assets. Know that this fair value model is not the same as what? Revaluation model. In IAS 16, we called it what? Revaluation model. But when we come here, we call it fair value model. Know that there are differences. In IAS 16, we have two models. We have the cost model and then the revaluation model. But when you come to investment property, there are two models. The cost model, just like the IAS 16, and then fair value model. So that they are two. So take note of that. So in exam MCQ, I can bring, there are two subsequent measurement, evaluation model and cost model, fair value model and cost model. So these are the responses that I'll give you. Somebody would, and definitely I will make sure that the evaluation model and cost model will be the first option. A lot of you will be choosing it. So take note, my exams, you have to be vigilant. Be vigilant. All right, so that is it. Move on. So now we are looking at the subsequent measurement, the cost model. I'm looking at it in detail. So just is the same as what? The IAS 16. If you are using the cost model, the same as the IAS 16. The properties are depreciated like any assets, as we learned in IAS 16. However, an entity that chooses the cost model discloses the fair value of the investment property. In as much as you are using the cost model, you are supposed to disclose the fair value of the property. Now, fair value model, if you are using the fair value model, the investment property are remeasured to fair value at each statement of financial position date. As at the end of the reporting date, you have to remeasure the property at its fair value so that you use the fair value in the financial. So the fair value should reflect market conditions at the end of the reporting period, right? And finally, I told you here that at the end of the reporting date, at the end of every reporting date, you have to remeasure the asset to its fair value, right? So after measuring it to its fair value or determining its fair value, definitely when you compare it to the carrying amount in the box, there's definitely going to be a gain or a loss. So if there is a gain or a loss, you have to recognize it in the financial statement, in the P&L account directly. Here, unlike the revaluation model where revaluation gain will go to other comprehensive income, here Again, on the revaluation, will go straight to the income statement, go to profit and loss account. And if there is a loss, you go to profit and loss account. It's not complicated like the revaluation model. Just compare the fair value to the value in the books. If it's a gain, add it to profit. If it's a loss, add it to expense. That's all. Very simple. It's one of the simplest ones, standards. That's why you are learning at this stage. Then when you get to final year, you learn the complex ones. Okay, so properties are not depreciated when you're using the fair value model. Properties are not depreciated. This is what you should know. But when you go to the revaluation model, properties are depreciated, right? But here, properties are not depreciated. And at the end of every reporting period, you should determine the fair value of the asset. Properties are not depreciated. So with the fair value model, this is what I've said so far. Investment should be remeasured to its fair value using IFRS 13 fair value measurement. At the end of every reporting period, you have to remeasure the property to their fair value. And there can be a gain or a loss on the remeasurement. So if there is a gain or loss, it should be charged to profit and loss account. If there is a loss, you debit it to profit and loss account and credit it to the investment property. But if there is a gain, you credit to the profit and loss account and then debit it to the investment property. No, the investment property is an asset. So if it is increasing, you debit it. If it is reducing, you credit it. And again, no depreciation is charged for fair value model. Is it clear up to this point, friends? Is it clear up to this point, friends? Is it clear? Are you following? Are you following, friends? Good. We can move on. Now, so we are also saying that if you are using the fair value model and you are unable to measure the fair value reliably, and if the investment is under construction, then you have to measure it at cost. But if it's not under construction, then you have to use the cost model according to IAS system if you're unable to determine the fair value. If your accounting policy is to use the fair value model, but then at the end of the reporting period, you are unable to measure the fair value reliably, then use the cost, go by the cost. Okay, carry the item as what? At cost. That's what the standard is saying. So take notes. Now, cost model. Let's look at the cost model. So we've said that the cost model should be measured in accordance with IAS system. The prescription for a cost model in line with IAS system should be applicable here if you are using the cost model. But if it's classified as held for sale, then you have to use what IFRS 5, non-current asset held for sale. So this asset, there are several aspects of it. There are PP 16, investment property 40, intangible asset 38, non-current asset held for sale IFRS 5, and all that. So if the asset has been held for sale, then you have to use IFRS 5 to account for it, non-current asset held for sale. Now, transfer of investment property. Transfer of investment property. You can only transfer investment property only when there is a change in use. So you can transfer investment property to owner occupied. So an item which used to be investment property, you can now transfer it to be what? Owner occupied. You can now remove it from investment property and rather add it to your PPE because owner occupied is PPE. But you can only do that when there is a change in the use of the asset. You have changed its use from investment property, it being investment property, to what? Owner occupied. Is that okay? When there's been a transfer from investment property to inventories, now you are going to be selling those assets. So it has now become inventory. So you account for it using IAS 2. When you are transferring it from owner occupied to investment property, it used to be PPE. It used to be for production or supply of goods or for administrative purposes, but now you want to hold it for what? Investment purposes. So you have to change the accounting treatment for it. And then transferring it from inventories to investment property. You used to sell them but now you want to hold it for what? Capital appreciation or for rental purposes. So that's the transfer of investment properties. So anytime you are transferring it from one um, classification to the other, you have to derecognize it from that classification and now recognize it in the other classification. So if it's used to be investment property, subtract the value that you are transferring from the value of investment property, and now you add it to PPE. If it's PPE to from PPE to investment property to you transfer, you subtract the value of the investment property. Okay, sorry. Yes, you subtract the value of the PPE from what? That's being transferred from PPE, and you now add it to the value of investment property with all the derecognition, the fact that the act of subtracting it from one group and taking it to the other. By subtracting it from one group, you are derecognizing it. Is that okay? So anytime there's transfer, you have to derecognize it from the previous what um state, and now you now recognize it in the new state. Is that okay? So that is derecognition on transfers. We also have disposal of what investment property. An investment property should be derecognized on disposal or when the investment property is permanently withdrawn from use. Okay, from its use as being what investment property. And whenever there is disposal, just as we dispose for what PPE, there's gonna be a loss or a gain on what disposal, profit or loss on disposal. So if there is a profit on disposal, what do you do? If there is a loss on disposal, what do you do? It's the same as what we learned in financial accounting. It should be recognized in the income statement. If it's an expense, if it's a loss, you treat it as an expense. If it's a gain, you add it to um, other income to be added to the gross profit. Is that okay? Now, how do you determine the gain or loss on the investment property? The net disposal proceeds when you are selling it, the amount that you are going to get minus the carrying amount of the asset. The net disposal proceeds minus the carrying amount of the asset will give you the gain or the loss. If there is a gain, add it to gross profit. If there is a loss, add it to expenses to be subtracted from your gross profit to arrive at your net profit. So that's what the standard is saying. Whenever there is disposal, you have to derecognize it, right? Derecognize it by subtracting the value of the investment property you are disposing, subtract the carrying value from your investment property, okay, amount, and then determine the profit or loss on disposal. If there is any profit or loss on disposal, you should go to the profit and loss account. And how do you get your profit or loss on disposal? Net disposal proceeds minus carrying amount. And when again do we derecognize? When the investment property is permanently withdrawn from use as such. If it's permanently withdrawn from use as what investment property, you also have to derecognize it. And you can also transfer one classification of asset to the other, right? From investment property to PPE, from PPE to investment property, from investment property to inventory, and what have you, just as we learned here. So this is what the standard has for us. And the last slide is what disclosure requirement. So what do you have to disclose? You have to disclose whether fair value or the cost model is used. That's your accounting policy for investment property, whether you are using the fair value or you are using the cost model. That's your accounting policy for investment property. So you have to indicate it. And if fair value model is used, whether property interest held under operating lease or classified and accounted for as investment property, the methods and significant assumptions in determining the fair value. You were told that every reporting year you have to what? Remeasure the investment property at its fair value. How did you arrive at your fair value? To the extent to which the fair value of the investment property is based on evaluation. How did you do it? Did you evaluate yourself? How did you go about it? Did you hire a qualified independent valuer to do it? You have to disclose all this information. If there's been no such evaluation, you have to disclose it. Maybe you couldn't determine the fair value. Disclose it. The amount recognized in profit or loss. in rental income, you have to disclose it. We told you that investment property is held for rental income and then for capital appreciation. So the rental income you derive from your investment property, you are supposed to disclose it. The operating expenses you incur, that like example repairs, maintenance, and those things on the investment property, you have to disclose all of them. But when you go through the standard, there are a whole lot that you can even disclose. But these are the major ones, the major disclosure requirements. This is the end of it. I told you that it's a very simple standard. So in final accounts, company final account question, if you see anything that meets the definition of investment property, just classify it as such. That's all you need. So any question from me? Otherwise, we can end it here. Any question for Beatrice? Otherwise, we can end it here. All right.